Good morning, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. We're going to get to what you need to know before you roll, and that's going to start out with talking about the economic data, see how that impacts the overall markets with a little market analysis, maybe sprinkle in some geopolitical fodder to round that off, and then talk about some option strategies we could look at to implement into our own portfolios based on assumptions we come up with in our market analysis. All right, so today is going to be a pretty busy day, folks. We've got a lot of economic data. One thing, though, it's going to feel a little bit hectic, I think, and we could see continued volatility as some of the major players in the markets are not being involved right now. Why? Because they're on vacation. They have a bank holiday, so a lot of folks aren't trading then across the pond. That goes for China and Japan. They are still off today. They were off yesterday, they're off today, and Japan's even off tomorrow. So when you guys are all complaining about 4-day weekends, wanting to have something like that, or even just 3-day weekends, these folks are working on a 5-day weekend. All right, so crude oil, let's talk about that. Well, a couple other things I wanted to talk about with the economic data and geopolitical fodder right now is factory orders a little bit later on today. Watch Phil LeBeau for the vehicle Ward or the Ward vehicle sales. Those kind of sprinkle in throughout the week. And then the other thing is tomorrow is the FOMC meeting. Today is the start of the 2-day meeting. Some of the volatility we've seen in the equities yesterday and even overnight already is going to be due to folks really trying to shore up some positions, hedge ahead of this interest rate hike. Probably looks like it might be about a 50 basis point hike on the docket there. They're going to be talking. Remember, they get the blue book. I talked about this earlier on, and we said that the Fed likes to look at the blue book because they get that as a gauge of the economic sentiment going into that meeting. Now, we get the beige book, comes out a couple of weeks ahead of time. Economic data is not going to change that much. And as a matter of fact, if we get something like the ISM, Institute for Supply Management, that is forward looking. So that will almost even trump the blue book that they have. So we're going to be keeping a serious eye on that for the markets to make a move based on that data. But again, with the lighter volume, because China, Japan, both big players are out of the market right now, this market could get a little jukey. So let's talk about crude oil here. We've got on the markets, we've got crude oil staying above that 50-day simple moving average here. Continued demand. One of the things that'll be a driver here is the ISM, Institute for Supply Management, being forward looking. It is the manufacturers. Okay, so if we see a really good number here, that will lead one to believe that these markets are going to move higher because of that demand, right, going forward. So we can get those levers and pulleys going on in our head. So watch out for that heading into tomorrow. All right. So that's going to be coming out before the FOMC statement. The FOMC statement will widely be encompassing things like that number there. All right, bonds. You know, we've been talking about the bonds. Interest rates on bonds approaching 3%. Actually, in the 10-year, I should say, is approaching 3%, not necessarily the bonds. So let's just throw up the 10-year here since I'm talking. Z, folks, /ZN, I believe, isn't it? Yep, bonds, or sorry, notes. So notes continue to slide here. Interest rates in the shorter duration are jacking up quicker than the longer duration, getting that yield curve inversion, signaling a recession. So 10-year approaching 3% here overnight now. Gold futures continue to slide. This is like a major conundrum for me because I don't know that we've seen the downside in equities just yet. So with that said, inflation fears, we've got the Fed getting ready to raise interest rates. That should be driving gold higher. One of the only things of the levers and pulleys that's really kind of creating this is the strength in the dollar and possibly the future expectations of dollar strength. So that will cause weakness in things like gold here. So that's the only thing that I can come up with for why gold is starting to slide, other than it's a cash grab or it's just a little bit overdone from the strength in the dollar there. Bitcoin, really nothing to see here. It does not seem to be the limelight right now. You could see on the volumes there that the volume in Bitcoin is really kind of cratering there. If you can see down here at the bottom right here, inside of there's some volume bars, just really not a whole lot of interest there. VIX yesterday, massive spike up into the high 30s there. That was as the markets were really falling out of bed there, but a nice snapback towards the end of the day. We can kind of break these charts down into 30-minute charts even and see that there was a nice snapback yesterday late in the afternoon. I don't have the grayed out areas like I do in the E-mini S&Ps there. But again, that snapback yesterday, making this look like a pretty solid bottom, although it did not touch on any of those levels that I was looking for. We did come very close to it. It's giving me a bit of pause that I think that we have to go down there and hit those numbers going forward here. See, we can just shy of this overnight. As a matter of fact, the Dow Jones Industrial Average was down almost 200 points overnight, and then back into positive territory. E-mini S&Ps were in negative territory as well overnight, but a nice little snapback heading into the open here. Is that going to sustain that? I don't know, folks. It's just there's such a wild card in what the Fed might say tomorrow and or do that that I think folks are really a little bit concerned about putting a lot of money to work right now, which means that's why we're getting that bit of a cash grab and not seeing gold act like we normally would with equities having this kind of sell-off here. But again, E-mini S&Ps, yesterday's nice snapback, but you can see overnight looked pretty strong, sold into negative territory, and now we're snapping back right to about unchanged heading into the open. Dow Jones, NASDAQ, both of those markets heading into that. That's because the overnight folks really don't have any idea either. They're the traders that are staying up all night and they're trying to cover that position ahead of the open. They don't want to have a directional assumption heading into this is what it feels like. And I think that that's the way the broader market is right now. It feels like it is going whichever direction the wind is blowing at this point. And a lot of that has to do with lack of volume here. It is a lot of traders that are not going to have long-term positions, which is going to cause this market to start rolling over. Remember, at the start of all of this, I said we had all gotten into the NASDAQ. We drove the NASDAQ much higher at a faster pace than the broader markets there. It was going to have more of an exacerbated or downside move there. Well, we've seen all of that, right? And then I said, once that NASDAQ starts pulling out, folks are going to fly into the E-mini S&Ps and support that market because it didn't have that upward trajectory like the NASDAQ. And as the NASDAQ's falling, we're going to start seeing money go into the E-mini S&Ps and the Dow Jones Industrial Average. That's pretty much what we saw with those supports. But having said that, I said, that's where we're going to see that money flow, but that is going to be the weak hand because folks haven't really fallen in love with that trade at this point. They're still a little unsure as to whether or not they're paying up too much for it, right? And that, which is, you know, the real conundrum here. Are you buying low or are you buying high right now? Nobody really knows, and that's the real crux of the situation there. And I talk about how you can determine whether at least the options are cheap or expensive over there in the option montage. That's the one thing that we can do is at least tell if options are cheap or expensive. So right now, options are not super cheap across the board. And we'll talk about how to determine that in Thursday's webinar where I really drill down on that. All right. So real quickly, I want to do a little run through of some markets here, as this is what I would normally do on I normally do in the morning. So I thought, why aren't I sharing this with you guys? Basically, I just pull up the watch list here with my charts right next to it. Option montage on the other page, just to keep an eye on it. But then I just kind of start. I like to start at the top, and you can see I filter my underlyings from the implied volatility percent. Okay, and it's the last 6 months. I don't go the last year because we've had too much turmoil, and it seems like getting that data point down to the gnat's ass is really what we want to do. All right, so TBT, stay away from that, folks. It is triple leverage, so that would be something that could be catastrophic if you're thinking you're going to find a bottom in the bonds. That market's going to really go to the top. All right, so we can look at some with the earnings. This is something I would do normally on earnings. heading into those, try and find the ones that have earnings after the close today when I'm flying through here and looking for opportunities there, because as you can see, volatility extremely high for every underlying. As a matter of fact, breaking the paradigm of what we were thinking was relatively high volatility for some of these underlyings. Usually we see it revert back to their mean, if you will. So a lot of markets making those bottoming patterns today. But like I said, normally I would really start to jump on some of these markets, but just the way that these dead cat bounces have been happening in the markets. And what I mean by a dead cat bounce, folks, is when the markets are selling off and all of a sudden folks start to see those bottoming patterns happening. And we're going to see a lot more of those happening with the lack of volume there. But what we're looking at, let me just find a couple of greens. A dead cat bounce would be a couple of green arrows here, and then the sell-off happens, boom, and then maybe you get a couple of little green arrows, boom, and then the sell-off. The green arrow is that dead cat bounce where you get that little bit of a pause where folks, all right, this is a time where I'm going to start stepping in, and then if the market starts rolling, those folks with the real weak hand start selling into it as well. And again, as exacerbating that type of action to the downside there. And then just flip through the markets and try and find something that sticks out at me. As a matter of fact, I don't even really look at the ticker as I'm flipping through the sides. I'm just looking for setups. There was a pretty good one a couple of days ago, and Applied Materials there. eBay, not quite a confirmation, but looking like it's trying to dig its heels in the ground there and start flipping through the markets. As a matter of fact, ABT looking pretty good for upside there. We got high volatility. We've just had their earnings, so the high volatility following that earnings, well, that's a really good opportunity to get involved with selling high, meaning selling premiums when they're at extreme levels. And we can tell that by looking at volatility right now that ABT has really expensive premiums over there. So that would lead me with a bullish type of direction. Now, of course, I would need to wait for something like this to get confirmed to the upside, especially in a market right now. So looking to see something want to trade above that previous high there and settle. Okay, so that's what we would be looking for in a bullish confirmation here. That would lead me, bullish confirmation, extremely high volatility. I got to sell premiums. Well, I don't want to sell calls in that because that would be bearish trade. So selling some puts is what it looks like it would be doing here, depending on how strong our bullish assumption is. But with implied volatility this high, you just need to take advantage of that high premium as far as I'm concerned. So something like this would be selling puts. And I'm going to really drill down on the details of a trade setup like this and how we would go through those steps to find the optimal option strategy for any given assumption. It's not just always buying a call on a bullish assumption, which I've been seeing a lot of folks do these days. And they're getting away with it, to be quite honest. They're getting away with buying calls and bullish markets and buying puts in bearish markets because volatility is pretty elevated right now. They've gotten away with getting an incremental click higher. So it's not so much hurting folks. But what I'm really concerned about here is that when we get these volatility spikes like this, you can see how fast that volatility comes out of these markets. And I would expect something like that. Having said that, bullish market, even if the underlying starts moving incrementally higher, we could see this volatility crater out and it would erase all your gains. I'll show you how those levers and pulleys work out in that video on Thursday. So please make sure when you're subscribing, make sure you guys hit that little light bell down there next to it, because that'll tell you in videos like this when I'm really unannounced that I'm chatting it up. If you guys want to participate in that, that's how you do that. That's how you get that notification. All right. So before you go, make sure you smash that like button for me. It does help feed those bots for me. So take that. Folks, take it easy. Good luck trading now.